Welcome to the Deep Dive. Today, we're tackling, well, a giant. A force that's so big, so everywhere, you almost need a map to understand its influence on the modern world. We're talking about BlackRock, Inc., the world's biggest asset manager.
Right. And our mission today, based on the materials you shared, is to really dig into this. We have to look at the numbers first, the sheer scale, the growth, the tech behind it all. It's massive.
Absolutely. And then we need to wade into the, let's say, more complex stuff, the controversies, the political links, the way it shifts markets, even how companies think about social issues.
Exactly. It's a story that goes way beyond just finance. We've got some really detailed sources here, a mix of financial deep dives and more investigative stuff.
So let's get right to it. The scale. We just have to start there. As of the end of 2024, Q4, BlackRock's assets under management, their AUM, hit a new record.
Yeah.
$11.6 trillion.
Yeah, and that number, $11.6 trillion, it's almost hard to process, isn't it? It was up nearly $2 trillion in just 1 year.
It makes your head spin. So how do we even wrap our minds around that?
Well, the sources did try to give some context. Think about this. $11.6 trillion is roughly a third of the entire U.S. national debt right now.
A third of the debt.
Wow. Or, put another way, it's nearly half of America's total economic output for a year, the GDP. So you've got one company managing assets worth half the U.S. economy.
That's staggering.
It gets wilder. One source did the math. If you took all that money and gave it out equally to every single person on Earth.
Every man, woman, child.
Yep, everyone. It would be about $1,500 per person.
$1,500.
For everyone.
Just from one company's managed assets.
Or compare it to other giant companies, it's like 4 times bigger than Apple's entire market value. So BlackRock isn't really comparable to a normal company anymore. It's more like, well, an economic force of nature.
An economic sovereign almost.
Yeah, that's a good way to put it. And when you have that much capital concentrated in one place, the normal rules of business kind of bend. You're not just playing in the market, you're shaping it. You're influencing regulations, maybe even global logistics, political decisions. This scale is the bedrock for everything else.
Okay, so how did they get this big? Let's unpack the basics. Founded back in '88, based in New York, they offer all sorts of investment stuff, stocks, bonds, alternatives.
Right, a whole range. But their explosive growth is really tied to one thing more than anything else: ETFs, exchange-traded funds. Specifically, their iShares platform. That's been huge for them.
And that leads straight into the index fund model, doesn't it?
Exactly. And for our listeners, you probably know the basics. The idea, pioneered by John Bogle at Vanguard back in the 70s.
Diversify across the whole market. Don't bet the farm on single stocks.
Yes.
Passive investing.
Precisely. It's about spreading risk. What BlackRock did so brilliantly was scaling this up. They convinced the really big players, pension funds, retirement plans, sovereign wealth funds, to park their massive pools of money with them. Why? Because index funds are seen as low risk, low fee.
It's about stability,
Yeah.
right? Compounding over the long haul, not flashy short-term gains.
Absolutely. And this focus on low risk, the sources point out, comes directly from Larry Fink, the co-founder. He had this huge failure early in his Wall Street career, lost $100 million.
Ouch.
Yeah. And apparently that experience made him obsessed with avoiding risk. So BlackRock was built from the ground up with that mindset, risk mitigation above all else.
Okay, so index funds are key.
Yeah.
But BlackRock isn't alone in this space. You mentioned Vanguard.
Right. You really have to talk about the big three. That's
Yeah.
BlackRock, Vanguard, and State Street. They're like the triumvirate of index investing. Together, they basically own, well, a huge chunk of the global economy.
How huge are we talking combined?
Well, let's see. BlackRock's $11.6 trillion. Vanguard's around $10 trillion, give or take. State Street's maybe pushing $5 trillion. Add that all up.
We're talking somewhere in the ballpark of the entire U.S. GDP. Just those 3 firms.
Pretty much. It's staggering. And this isn't just 3 big finance companies. The sources are clear. This is the ownership structure for most big publicly traded companies globally.
You see this really clearly when you look at the S&P 500. BlackRock's footprint there is just everywhere.
It really is. The source material says BlackRock owns, on average, a 5% stake in 95% of the companies in the S&P 500 index.
So roughly 475 out of the 500 biggest companies.
Exactly. Now, that 5% figure is crucial. It's not usually a controlling stake. If it were, they'd face way more regulation.
Right, it's below the threshold.
But it's what you'd call a sensitive package. It's big enough to give them enormous influence. They get voting rights on corporate boards, in proxy fights.
So they can sway decisions without technically being in charge.
Precisely. They wield massive power, but they can maintain this public image of just being a passive, neutral manager of other people's money.
Let's name some names, though. Where do they have these stakes?
Okay, well, tech is huge. They're the second biggest shareholder in Apple, about 6.7%. They've got 7.3% of Microsoft, 7% of Alphabet, which is Google, 7.5% of Meta, Facebook, 6% of Amazon.
So the absolute giants of the digital age.
Absolutely. But it's not just tech. It's everywhere. Pharmaceuticals, think Pfizer. Consumer goods, Johnson & Johnson. Soft drinks, they own big chunks of both Coca-Cola and PepsiCo.
Both. Interesting.
Yeah, we'll come back to that. Banks, JP Morgan Chase, Bank of America. Entertainment, Disney, Netflix. Retail, Walmart. Media, Fox, Comcast. The list just goes on and on.
It really drives home that point one source made. Think about your average day.
Right. You wake up, maybe check your phone, Apple, Google, Meta involved, grab a soda, Coke or Pepsi, do some shopping, Amazon, Walmart, watch TV, Disney, Fox, Comcast, pay a bill, JP Morgan, Bank of America.
And at every single step.
BlackRock is there, holding a significant, influential piece of the puzzle.
Which brings us back to that distinction they always make between owning the assets and just managing them.
Yeah, that's their key defense, legally speaking. Formally, the stocks, the bonds, they belong to the clients. The pension funds, the individuals with retirement accounts. BlackRock is just the manager, the fiduciary.
But practically.
Practically, BlackRock holds the reins. They manage over $11 trillion. And crucially, they exercise the voting rights that come with those shares. They don't call up millions of pensioners asking how to vote on Apple's board strategy.
No, of course not.
BlackRock executives make those calls. They shape corporate governance globally, all while saying, hey, it's not actually our money. It's a very effective structure for wielding power without attracting quite as much direct accountability.
And this level of control, this influence, it's built on a foundation of just relentless financial performance, isn't it?
Absolutely. You don't get to $11.6 trillion by accident. Their growth has been incredibly consistent. The sources mention a compound annual growth rate, CAGR, of around 20% over the last decade.
20% a year compounded? For a firm already that big? That's aggressive.
It's phenomenal, really. And the recent numbers just back this up. For 2024, full-year revenue jumped 14% to over $19 billion. Operating income grew even faster, up 23%. They hit a record operating margin, 44.5%.
That margin is huge.
It is, and they're returning a lot of cash to shareholders, too. Over $4.7 billion in 2024, including buying back $1.6 billion of their own stock. This isn't a company treading water. It's built for dominance.
And a big part of that seems to be smart strategic acquisitions, moving into new growth areas.
Definitely. They're clearly focused on expanding beyond just traditional stocks and bonds. Alternatives are a huge push for them.
Like that HPS Investment Partners deal.
Exactly. That was December 2024. A $12 billion all-stock deal. Why? To massively expand their presence in private credit.
Explain private credit quickly.
Sure. It's basically lending directly to companies, often bypassing banks. It can offer higher returns, and it's generally a less regulated space than public markets. Very attractive.
So this HPS deal was significant.
Oh, yeah. HPS managed about $148 billion. BlackRock already had around $89 billion in private debt. Combine them, and suddenly BlackRock's private credit arm manages something like $220 billion. Big leap.
And they also bought Global Infrastructure Partners recently too, right?
We did. Completed that in 2024. Another move to beef up their private markets side, this time focusing on essential infrastructure, things like airports, energy pipelines, ports.
Okay, hold on. Ports. That seems different.
It is. And this is where it gets really interesting, moving beyond pure finance. One source highlighted something quite stunning. BlackRock acquired 2 strategically vital ports, one on each side of the Panama Canal.
The Panama Canal. When?
And that's not all. At the same time, they apparently secured a controlling stake in 43 other ports across 23 different countries.
Wait a minute. Owning ports, especially around a global choke point like the Panama Canal, that's not just finance. That's geopolitics. That's controlling trade flows.
Precisely. It gives them leverage over supply chains, over governments even. And here's the kicker. The source mentioned that the estimated cost for the Panama Canal ports deal, maybe $23 billion, was described by some insiders as basically coffee money for BlackRock.
Coffee money for $23 billion.
That phrase tells you everything, doesn't it? It shows the scale they operate on. It signals that controlling global logistics is now seen as just another asset class for them, something they can pursue aggressively. It puts them in a position of influence normally held by nations or military alliances.
Incredible. Okay, let's shift back to the more traditional financial view. Their stock price. There seems to be a bit of a paradox there, according to the analysis.
There is. As of early 2025, the formal analyst recommendation was often a hold, but the stock price itself was pretty high, around a $975. The target price, though, was way lower, maybe $850 or so.
Suggesting a potential drop of over 20%.
Right. So the raw numbers, like a discounted cash flow analysis, which tries to calculate the true value based on future earnings, suggested the stock was overvalued, maybe significant.
But analysts weren't saying sell. They were saying hold. Why?
Well, it implies they're pricing in something beyond the pure math. They're looking at BlackRock's leadership, its strong fundamentals, yes, but also its sheer market dominance, its political connections, its stability.
So they're essentially betting that BlackRock's unique position, its too big to fail status almost, justifies a price higher than the fundamentals alone would suggest.
That seems to be the thinking. They're pricing in the intangible value, the power, the access, the stability provided by its sheer scale and its system, Aladdin. They're betting those factors will keep the stock elevated.
But that stability gets tested, right? There are risks, market reactions.
Constantly. For instance, their plan to buy Preqin, a big provider of data on alternative investments, something that would really complement Aladdin.
Right.
That deal is facing a pretty serious probe from competition authorities right now. A decision was expected around February 12th, 2025. If that gets blocked, it's a setback. It limits their ability to gather even more data.
And there was that Disney fight recently, too.
Yeah, the proxy battle earlier this year, BlackRock was right in the middle of it, being a huge shareholder. Trian, the activist investor, was challenging Disney management. Disney won the vote, but...
What?
The market reaction was interesting. Disney's stock actually dipped a bit right after. Some read that as the market thinking the activists, Trian, actually had the better ideas for fixing things, even though they lost the vote. These battles create uncertainty.
And what about crypto? That caused some waves, too.
It did, especially around Ether ETFs. First, there was talk of rejection, then they got approved pretty quickly in 2024. That whole saga created volatility. BlackRock's stock took a hit, bottoming out around $750 at one point.
But it recovered.
It did. Strong earnings helped, plus they keep making these big strategic moves, like pouring $30 billion into manufacturing ETFs and AI infrastructure funds, partnering with Microsoft. They seem pretty resilient to these short-term shocks.
Let's talk about the person at the top, Larry Fink. Because his story seems really central to understanding BlackRock's whole philosophy.
It really is. He wasn't always Mr. Risk-averse. He started out at First Boston, was a Wall Street star, actually. He was pioneering mortgage-backed securities back then.
The very things that blew up in 2008.
Some of the precursors, yeah. He was experimenting heavily. But then came 1986. He made a bad call on interest rates. Cost the firm $100 million.
$100 million. Back then, that was huge.
Massive. And apparently, that loss deeply affected him. He's talked about it. It's what drove him to found BlackRock with this intense, almost obsessive focus on managing risk, on avoiding that kind of catastrophic loss.
So BlackRock wasn't built to chase the biggest returns, but to avoid the biggest losses.
Fundamentally, yes, through sophisticated risk management. And that brings us to Fink's leadership style, now confident, incredibly politically savvy. He always emphasizes that BlackRock is built to perform no matter who's in power, Democrat or Republican.
That adaptability seems key.
It is, and it comes from, well, deep connections, which we'll get to, and also from their technological edge. Now, the analysts do point out one potential risk: succession. Fink isn't going anywhere immediately, it seems, but what happens when he eventually does step down? That's something the market considers.
But maybe the real core isn't Fink himself anymore, but the technology.
Aladdin?
Ah, Aladdin, yes. That's the secret sauce, the asset liability depth and derivative investment network. It's their proprietary AI system, basically. Been developing it in-house, very secretively, since the late 80s.
And it's more than just a trading platform, right?
Oh, much more. Think of it as a massive real-time risk assessment brain. It runs on thousands of computers and secure data centers. Its job is to analyze everything, financial data, sure, but also political news, regulatory changes, even things like weather patterns that could impact investments.
Weather patterns, really?
Apparently so.
Yeah.
Anything that could represent systemic risk.
Yeah.
And the scale of its influence is just mind-blowing. It isn't just manage BlackRock's $11.6 trillion.
They sell access to it. Exactly. To other huge clients, pension funds, competitors, even central banks use Aladdin. Add it all up, and the system is estimated to monitor or directly manage over $20 trillion in assets globally.
$20 trillion. That's almost the entire U.S. GDP managed or monitored by one computer system.
It's effectively a financial black box. The sources say it uses incredibly complex secret math probability theory, advanced stuff, and it's constantly learning, incorporating new AI, neural networks now. Fink was hiring PhD mathematicians and programmers way before AI was the buzzword it is today.
What's the advantage of that?
Information supremacy. Aladdin can spot connections humans might miss, like how a drought in Brazil could ripple through coffee prices, infrastructure bonds, and maybe even political stability next door all at once.
And because it's a black box.
It's unchallengeable. If someone asks BlackRock, why did you just sell $1 billion of X? They can essentially say, Aladdin's analysis indicated heightened risk. And who can argue with the secret math of the supercomputer? It provides a layer of objective justification.
Okay, so you have this technological powerhouse. How does that connect with the political side? You mentioned connections.
Deeply interwoven, BlackRock operates a very effective revolving door with governments all over the world. They donate heavily to political campaigns, mostly Democrats, but enough to Republicans to keep lines open everywhere.
Ensuring access no matter who wins.
Pretty much. And the flow of people is constant. Top government officials leave office and land high-paying gigs at BlackRock. The source material had a really specific example.
UK one.
Yeah, George Osborne, former UK Chancellor of the Exchequer, apparently worked for BlackRock just 1 day a week for £650,000 a year.
£650,000 for 1 day a week.
That's the reported figure. What does that buy BlackRock? Unparalleled insight into how government works, how decisions get made, who to talk to. Priceless strategic intelligence.
And it flows the other way too, right? BlackRock people going into government.
Absolutely, especially into key financial roles, the Federal Reserve, the SEC, the Securities and Exchange Commission, the agency that literally regulates BlackRock. You get people moving into positions where they're setting the rules for their former employer. It creates a very cozy relationship.
And this wasn't just background influence. They got directly involved during crises.
Big time. During the 2008 financial meltdown, the U.S. government brought in BlackRock's advisory arm to help figure out what to do. And interestingly, BlackRock helped rescue Bear Stearns.
Which used Aladdin, right?
Which was reportedly connected to Aladdin. Meanwhile, Lehman Brothers, which didn't use Aladdin, went bankrupt. Now, correlation isn't causation, but it certainly fueled speculation that Aladdin's insights influenced who got saved.
That's a heavy implication.
It is. And then in 2020, during the pandemic market panic, the Fed hired BlackRock directly to manage $750 billion in asset purchases to stabilize things.
So the Fed outsourced a massive part of its crisis response to BlackRock.
Essentially, yes. Now, BlackRock insists there's a strict Great Wall of China between the part of the company advising the Fed and the part actually managing investments to prevent conflicts of interest or insider trading.
But how believable is that wall, really?
That's the question critics ask. When Larry Fink oversees the whole operation, can that information truly stay separate? It's hard for many to swallow. Some sources even pointed out, with a bit of cynicism, that Fink was involved in creating the mortgage products that fueled the 2008 crisis in the first place. Yet BlackRock managed to get out of most toxic assets just before the crash, suggesting perhaps that Aladdin gave them a very timely warning.
Okay, with this much power, it's inevitable that BlackRock becomes a target for controversy, especially around social issues. ESG seems to be a big one.
Oh, huge. Environmental, social, and governance criteria. Larry Fink really put BlackRock out there on this initially. He publicly championed what critics on the right started calling woke capitalism.
What did that mean in practice?
He basically said BlackRock would use its voting power to push companies on ESG goals. They'd vote against boards that weren't, in his view, focused enough on things like climate change or diversity, the woke agenda, as he termed it. It was a major statement, using financial clout to drive social change.
How did that go down?
It backfired spectacularly, really, from both sides. The political right and conservative states went ballistic. They saw it as BlackRock, strong-arming companies, forcing a green agenda, hurting industries like oil and gas.
And there were real consequences. States pulling money?
Yep. Texas schools famously pulled $8.5 billion from BlackRock, explicitly citing Fink's criticism of the fossil fuel industry.
Wow. But did it win over the left, the activists?
Not really, no, because critics on the left immediately pointed out the hypocrisy. BlackRock was still a massive investor in ExxonMobil, Chevron, heavy industry, companies involved in deforestation in the Amazon.
So talking the ESG talk, but still investing in the bad stuff.
Exactly. They held stakes in companies building border walls, running detention centers. So the ESG push seemed selective, maybe performative to many activists. The financial returns still seemed to come first when push came to shove.
Sounds like they were caught in the middle.
Completely untenable, which led to the big reversal in 2025. Fink basically announced, okay, we're ditching the woke capitalism label. The focus is back purely on financial returns for clients.
And the impacts of that reversal.
Immediate and profound, according to the sources. Budget cuts for diversity and sustainability programs started at BlackRock and then quickly spread through the other big three and then cascaded down through corporate America.
So just like that, the social priorities of huge swaths of the global economy shifted because one guy at the top of BlackRock changed his mind.
That's essentially what the sources suggest. It shows the incredible power they have to set the agenda, even on social issues.
Okay, let's pivot to another big controversy.
Yeah.
Housing.
Right. This is a really potent accusation, especially in the U.S. Figures like Robert Kennedy Jr. have directly accused BlackRock and the other big three of making the housing crisis worse.
How so?
The argument is about their sheer buying power. Critics say because they have access to seemingly infinite money from investors, they can swoop in and buy up vast numbers of single-family homes, land, entire apartment buildings, not just in the U.S., but globally too. Places like Spain and Italy are mentioned.
And because they buy in bulk, often with cash.
They drive up prices incredibly fast. Much faster than average families trying to buy their first home can keep up with. They outbid everyone.
Making the American dream of homeownership even harder to reach.
That's the core accusation. And what do they do with these properties? Often they rent them out, becoming massive corporate landlords. Or sometimes, according to critics, they just hold them empty, further restricting supply and pushing prices higher.
Has this led to any legal trouble?
Well, related to their claims, yes. There was that lawsuit in Tennessee, filed late 2023. It alleged BlackRock was misleading investors about its ESG funds, basically saying funds were green when they still held lots of fossil fuel investments.
And the outcome.
They settled it early in 2025, didn't admit wrongdoing typically, but agreed to be much clearer and more transparent in their disclosures about what's actually in those ESG funds.
Okay, another really sensitive area mentioned in the sources, China. Specifically, investments linked to the Chinese military.
Yes, this was explosive. Reports surfaced claiming BlackRock had invested billions through Chinese stock exchanges into about 14 companies directly tied to China's military, the PLA.
What kind of companies?
Really problematic ones, according to the reports. Companies involved in China's nuclear weapons program and even firms linked to technology used in the Uyghur re-education camps in Xinjiang.
Areas the U.S. government has sanctioned.
Exactly. So you have the world's biggest U.S. asset manager investing client money in entities directly sanctioned by the U.S. government or involved in activities Washington condemns. It caused a huge outcry. Even George Soros publicly called on Fink to stop investing in what he called repressive regimes.
What was BlackRock's defense?
The usual one, fiduciary duty. They argue the money belongs to clients, many of whom are invested in broad index funds that simply track global markets, including China. If China is in the index, their clients are invested there.
But critics say that's not good enough.
Right. Critics argue that at their scale, BlackRock has a responsibility that goes beyond just passively tracking an index. They should be screening investments, especially when they could be funding activities directly counter to U.S. interests or values.
Okay, finally, the sources also touched on some. Let's call them conspiracy theories surrounding BlackRock. We should probably mention those neutrally.
Right. It's important to note these are allegations reported in the source material, not established facts. One revolved around a specific quote attributed to Larry Fink, supposedly saying population decrease is very profitable.
Profitable.
How? The alleged reasoning was that dying countries, meaning countries with aging or shrinking populations, would invest heavily in robotics and AI to replace workers, making it easier to automate jobs. Critics seized on this to paint a picture of Fink actively wanting fewer people for profit.
Skark.
What else? Media control is a persistent theme. And this one has some numbers behind it, based on their known holdings. We mentioned some earlier, 12% of Fox, 16% of CBS, 12% of CNN, 12% of Disney ABC, plus 10% of Sinclair, which controls a huge number of local U.S. TV stations.
So the theory is that the media doesn't criticize BlackRock harshly because BlackRock literally owns a chunk of the media.
That's the argument critics make. If the same three entities, BlackRock, Vanguard, State Street, own you and almost everyone else, you're unlikely to rock the boat too much.
And there was one more, even darker theory mentioned. About prisons.
Yeah, the prison industrial complex theory. It notes BlackRock holds shares in private prison companies. The allegation connects this to BlackRock's partial ownership of music labels, like Sony Music.
How are music labels and prisons connected?
The theory claims that these labels, influenced perhaps by owners like BlackRock, deliberately promoted certain kinds of hip-hop in the 90s, focusing on themes of drugs, gangs, violence, the alleged motive, to foster lifestyles that would lead to higher incarceration rates, thus keeping the private prisons that BlackRock also invested in full and profitable.
Wow. That paints a picture of incredibly cynical, systemic manipulation.
It's a very extreme theory, but it's out there, reflecting the deep suspicion and anxiety BlackRock's sheer size and reach generate.
Okay, so pulling all this together, the scale, the index funds, the acquisitions, Aladdin, the controversies, what's the big takeaway? The sources seem to focus on this idea of the competition paradox.
Yes, this is maybe the most fundamental point intellectually. What happens to basic market competition when the same few players own significant chunks of supposed rivals?
Like the Coke and Pepsi example you mentioned earlier.
Exactly. They're presented as archenemies, spending fortunes competing for market share. But look who the top shareholders are for both Coca-Cola and PepsiCo. BlackRock, Vanguard, State Street.
So, is it real competition?
Well, on the surface, yes, but the sources argue it changes the nature of that competition. When your major owners also own your biggest rival, are you really incentivized to, say, launch a brutal price war that hurts both companies' profits? Probably not.
It becomes more like managed competition. Two subsidiaries competing within the same larger portfolio.
That's the argument. It might discourage radical innovation that could disrupt the whole sector. It might lead to unspoken coordination on things like wages or environmental standards or responses to regulation. The appearance of choice for consumers might be, as one source put it, largely cosmetic in many industries.
Because behind the different brand names, the ultimate financial beneficiaries are the same handful of giant asset managers.
Precisely. And this level of centralized control, this sheer scale, it inevitably brings up historical parallels.
The East India Company one was striking.
It really was. A private company that became so wealthy, so powerful, it had its own army, its own fleet, more resources than the British government at the time. The line between private corporation and state power just completely blurred.
And the worry is, could something similar happen today? BlackRock has nation-state levels of capital. It's buying strategic infrastructure like ports. Its people move in and out of top government jobs.
It raises profound questions. One source even speculated, could the big three eventually just merge with the U.S. government or use their financial power to effectively control smaller nations? It sounds like sci-fi, but the trajectory is undeniable.
Which leads us right back to that core question. What are we actually looking at here? Is this still a free market economy as we traditionally understand it?
Or is it something else? When the biggest decisions affecting huge swaths of the economy are influenced, if not dictated, by three largely anonymous firms, often justifying those decisions based on the output of a secret AI program like Aladdin, it feels different.
The power dynamic seems almost inverted. Instead of the market emerging from millions of individual choices, it feels like strategic decisions are flowing downwards from this tiny, concentrated core.
Right, and BlackRock's growth isn't slowing down. The assets keep pouring in. The influence seems almost guaranteed to expand, to consolidate further.
We saw that clearly with the ESG situation. Fink snaps his fingers, announces a shift away from woke capitalism, and suddenly corporate policies change across the board, almost overnight. That's incredible leverage.
It really is. And that brings us to our final provocative thought for you, the listener, to mull over.
If Larry Fink and the Big Three can flip a switch and change the social focus of corporate America like that, what else could they decide to focus on next?
We've seen them move into infrastructure, private credit, global logistics. What other field, maybe something that seems completely separate from finance right now, space exploration, maybe, AI research, basic scientific patents, education policy.
Could BlackRock already hold that quiet, influential 5% stake there too, giving them a key vote that shapes the future direction in ways we don't even see yet?
Something to think about.
Yeah.
What aspect of our lives might be next to feel the gravitational pull of $11.6 trillion?
Indeed. Well, thank you for sharing those sources and joining us for this deep dive into the enormous world of BlackRock.